Should deficits really matter anymore? Although the former squatter and the current president agree on little, but both of them support large-scale COVID relief packages. Actually, Trump didn't, but anyway, basically it says that they both support the large-scale COVID relief packages, irrespective of their implications for federal debt and the deficits. Their agreement on the desirability of deficit spending is indicative of a political environment in which balancing the budget no longer seems to matter. But we have entered an era of deficit denial, in which austerity has become a dirty word, but the laws of accounting have not been repealed, and there are limits to but there are limits to debt sustainability and risks to and there are risks to probing them. The Republican budget hawks, marginalized and often silent during the Trump era, have ceded the high ground of fiscal responsibility, but it may be up to Democrats to rein in their own spending ambitions out of concern for the nation's long term future. Unfortunately, Democrats have migrated far from the fiscal conservatism of the late Paul Tsongas and Bill Clinton, but they have embraced a variety of justifications for larger deficits, and some of which have a factual foundation. Fiscal conservatives need to come to grips with these arguments and find areas of common ground. While we cannot expect to see a balanced budget during the Biden era, or likely in the years beyond it, the problems with debt are real, and hopefully we can agree on some intermediate fiscal objective that could stave off a financial meltdown in the decades ahead. The United States has already returned to the record debt to the GDP ratio that was last seen in the aftermath of World War II. IMF projections show the United States government debt burdening converging with that of Italy by 2025, but as Larry Summers points out today, the debt poses less of a risk to ultra-low interest rates. The low interest rates mean the cost of servicing debt can remain under control even with large amounts of debt. And while this may be true, this argument does have its limits. In 1946, interest rates were also quite low. The 10-year Treasury bond earned about 2.19%, but not dramatically above recent levels of around 1.2. But today's rate environment offers the federal government an opportunity to minimize the debt service cost by borrowing at what they call the very short maturities. For example, the 3-month Treasury bills recently yielded a 0.09%. If the government could convert its entire debt to a 3-month Treasury, the debt service cost would indeed be a tiny share of the federal budget, but rolling over debt so frequently comes with great risk. If the interest rates return to the levels that we saw during the 1980s, the debt service cost would suddenly consume half the federal budget, or more. In fact, some fiscal experts recommend locking in today's relatively low interest rates by lengthening the average maturity of the Treasury debt, and this would increase what they call interest expenditures in the short term, but it would reduce their volatility in the future. Another way to minimize interest costs for the Federal Reserve is to buy up more Treasury debt, something it did during the Great Recession and again in 2020. The Fed reimbursed the Treasury for most of the interest it collected, and its presence on the demand side of the bond market drives down interest rates for competing what they call bond buyers. The Federal Reserve must buy the Treasury securities with newly created money. All else being equal, and more money should cause the consumer price inflation, as it did during the 1960s or 70s, and the high inflation destroys lifetime savings, and it depresses the economic performance. But during the current cycle of debt accumulation and monetization that started under George W. Bush, consumer prices have only slowly risen. The lack of price inflation thus far has emboldened the supporters of the modern monetary theory, who are increasingly common in the Democratic Party. MMT proponents argue that the government can safely fund itself by printing money so long as the economy remains below the full employment as it is now. But the Federal Reserve money creation can cause distortions aside from consumer price inflation. Since the early 1980s, newly printed money has been pumping up the prices of investment rather than the consumer goods. While nominal GDP has grown a sixfold since 1983, the S&P 500 index has increased over 25 times. Stock prices are now well above pre-pandemic levels, despite the devastating impact that COVID-19 has on the economy's performance and the long-term potential. The high stock prices may seem like an unalloyed good, but there are some downsides. When the asset prices become inflated, they are more vulnerable to sudden drops, as we saw last March. Also, because stocks are disproportionately held by the affluent, inflated stock prices increased the wealth inequality. The lofty stock valuations have produced the centi-billionaires of today, such as Elon Musk and Jeff Bezos. Monetary inflation is impacting other assets as well. Gold is now 7 times more expensive than it was when George W. Bush took office. And today, hard-earned money investors are more likely to turn to Bitcoin, which rose by a factor of 40 during the Trump years. It remains to be seen how much of the run-up in Bitcoin reflects a speculative frenzy. But it is likely that a large portion of the price rise shows increasingly skepticism about the future value of the U.S. dollar. Foreign currency traders also appear to be worried about the dollar since it has fallen significantly against the euro over the 10 months of the pandemic. So the two major Democratic defenses of big deficits today have elements to truth, but also limitations. Interest rates are historically low, but there is no guarantee that they will stay there forever. The Fed monetary creation has only produced minimal price inflation thus far, but it appears to be affecting asset prices and the value of the dollar. If and when money printing feds through to consumer prices, it would likely trigger a spike in the interest rates as investors try to protect the real value of the principal. And with such high levels of debt, the result could cause a dangerous feedback loop. Higher interest rates increasing the federal interest costs, raising the deficit, necessitating more money, and creation could trigger more inflation and even higher interest rates. President Joe Biden suggested a third argument for high deficits that is shortly before taking office, but during his introduction of the $1.9 trillion American Rescue Plan, he said this: "It's not just that small fiscal investment, including deficit spending. It's basically they are more urgent than ever. It's that the return on these investments in jobs and racial equality, it will prevent a long-term economic damage, and the benefits will far surpass the cost. A growing number of top economists has shown even our debt situation will be more stable and not less stable. If we seize this moment with vision and purpose." These comments imply that running the large deficits now will improve the nation's long-term debt trajectory. This could only occur if the plan causes GDP and government revenues to grow faster than the debt to which it will add. And while theoretically possible, this is extremely unlikely. Many aspects of the spending plan do not have high fiscal multipliers, meaning that they will contribute relatively little to GDP growth. Further, the economy is likely to be ready, accelerating this spring as the pandemic and lockdowns ease, meaning that the spending package will probably only have marginal benefits. And while Congress is likely to pass additional COVID relief, a concern for long-term fiscal sustainability should relate for a much lower price tag than the $1.9 trillion that President Biden has proposed. But moving forward, Congress and the President should find new benchmarks to protect the fiscal well-being. Although a balanced budget seems politically impossible, restricting the annual growth of the debt to GDP ratio may be a reasonable goal that could attract bipartisan support. As the baby boomers continue retiring, pressure from Social Security and Medicare spending will continue to grow, and keeping an upper, what they call, limit on the national debt until this large cohort passes from the scene will protect succeeding generations from a fiscal calamity that could endanger their own retirement security.